Hey, good afternoon. This is Trader Tim from EminiMind.com, and we're doing sort of a trade recap video here on the Thursday, the 20th of January. I was hoping I'd have more intraday trading activity to talk about, and I really don't. The ES has not been giving a whole lot of opportunities intraday, and that's okay. Sometimes when we have these bigger trend shifts or trend breakdowns, there's not always, it's okay to sit patiently and kind of let things settle out a little bit, take in some, you know, observations, and um, there have been a handful of setups throughout the last week and a half, a couple of which didn't give me a fill, and then most notably, I suppose today, intraday on the ES, we had a high ticket highs at about an hour, 2 minutes after the bell, but we didn't break a swing low, and so that means that this short setup ends up being null, and I pass on the trade, and saves me from taking a stop out. So even though I haven't had a lot intraday going on, it's been all right because of the SPY puts that I bought here. And so I wanted to run through that trade and just kind of show you how you can operate your own portfolio like a hedge fund would. If you have presumably a longer term account of some kind or multiple accounts, or 401k from a job or something like that, you've got a big position going or building a bigger position. And so as we've talked about before, rather than closing the position out and buying it back and having to constantly get in and out of that position, um, what I like to do is hedge the position. And so what I will do is buy puts in the SPY. Just keep it super simple, directional puts. I don't get super fancy. If we take a look at the S&P for a moment, we can see a 10% pullback is still a little ways away on the S&P, but as far as the Nasdaq is concerned, we are already there. This is 10% off of highs in the Nasdaq, and so um, with that, we have an opportunity, or had an opportunity at this point. Now, in order to buy more puts, I would wait for a bit of a bounce now that we are back at the 50% long. So what I did is I talked about in last week's video, bought them at the close on the 12th, and then just kind of covered some a little bit along the way. I was targeting the 450 area, or the negative 23% target, which we have now hit today, and I have closed out of the remainder. And so I bought them for 350 and closed them out here about 17 bucks. So you know you can really do a lot with a little when it comes to hedging, and especially from the buying put side. When you're buying puts as the market is up, volatility is typically down, so they are very cheap. And then when you're covering them when the market is down, volatility is up, and they are, you know, not only are they in the money, but they're also up because of that implied volatility. So it's a great way to have, for 350 was essentially the most I could lose per contract on the position, and closing them out at 17. I also closed a few out along the way on the move down. But if you look at the daily highs, notice how we have not even broken above the prior day's high, and so I prefer to close out the position at the target, which in this case is also kind of back at the 50% long. But um, because if you wait and you wait for the market to break the prior day's high, that's a pretty big turnaround, and then you're closing the position out as it's going against you versus closing the position out as it's increasing in value. So that's just kind of my exit approach there. But I would strongly encourage you to take a look at that because I think we're going to have a lot more opportunities to sell bounces, or in this case, buy puts when the market bounces. This next 50% retracement could have a bit more or could have less resistance because we're retesting this larger daily 50% for the third time. I wouldn't be surprised tomorrow, Friday, if we come down, have a bigger intraday sell-off, and then come up with a um, rally at the close and kind of make a hammer down here. But a close below this 61.8 is what I'd be looking for to really break this halfway back long. And so basically, the 50% retracements work very, very well for buying puts because you're, like I said, you're buying them when the market is up and then you're covering them when the market is down and you're going with that momentum. I guess as far as intraday goes, I did have Wednesday. There was a larger 15-minute breakout trade that worked pretty well. The rest of the week is pretty much been blah, and that was Wednesday here. So it was just a matter of buying one tick below or selling one tick below the low of the first 15-minute candle, and then wrote it down to when we broke above this candle down here, basically putting a stop one tick above each candle on the way down. Um, if you are trading a small account and you want to trade both halfway backs and the 15-minute breakout, you could trade the micros using the halfway back method, and then you could do the breakout on the regular ES with one contract and just skip the first target and just do the trail. And that would be a way to be able to trade both contracts in one account. I don't really do any micro ES trading, but folks have said that sometimes prices are a couple of ticks off of MES to ES. So like if we look at the same trade on the micro ES, we come down here. Here's our low, roughly the same. But then over here, instead of getting out above this candle's high, notice how the candle before it broke the prior candle's high by a tick. So you may need to give it 2 ticks of wiggle room on the micro ES, and there's a little bit less volume just because it's a smaller contract, less traded, but the risk is a lot lower, so it does bode well for folks that are trading smaller accounts. And for folks who, it's helpful to trade multiple contracts when you're doing some type of a strategy that's not simply just trailing each candle as an all in, all out. So one contract works for the 15-minute breakout, but for trading micros, or for trading like halfway backs and that sort of thing, 50% retracements, where you're going to scale out, you're going to have a first target and then multiple other targets. Practicing with the micros with 2 contracts is better practice because then when you go to the regular ES, you'll be comfortable trading multiple contracts. And it's honestly, it's a lot easier to trade, I think, multiple contracts. Because like take this put hedge on the SPY, for example. I was able to close out of just a tiny portion at the very at the open on the let's see, no. So I put the position on the 12th, uh, took a tiny bit off at the close the very next day, just to kind of lock in guaranteed win. Still good reward to risk on that portion. I think they were like 680 was that closing price, and I bought them for like 350. So still, close to 1-to-1 on that reward to risk, and I'm just taking a very small portion off just to lock in a little bit, basically to give me a free trade, and then from there I can take a couple off if I want on a gap down at the open, or a sell off at the close when we're not quite at the negative 23% target, because a lot of times folks just get out too early. And so if taking a little bit off to ensure that you have a winning trade or a free trade, if that's what's going to allow you to stay in the trade longer with the remaining contracts to get that bigger winner, then by all means do it because it's going to help you get bigger winners over the long run. Ideally, sure, um, putting the position on at the highs and then holding the whole position down to lows is obviously the most profitable, but in a real world, that can be difficult to do. So hopefully you found a couple of tidbits in there that you can find helpful. I know most people probably have a 401k or an IRA or something that has a long-term position in it, and now I can take this cash or this position, those winnings, I can take that, and then I can buy up more of that Vanguard Growth Fund. I've got it that this was the 10% pullback line, just like the Nasdaq, made its little 10% correction. And if we can, it'd be nice if we could get maybe 15, 20%. That might be a bit much, but being able to take those earnings and buy more of the long term fund and then ride that back up, collect the dividends, reinvest, re-hedge, and that's essentially what a hedge fund is doing, building up these long-term positions or these bigger long positions, and hedging them with things like the S&P futures and various options and things like that. So I hope you found that helpful. If you have questions, you can drop them in the comments below, and look forward to another good week of trading next week, even if it means there's not a ton of intraday halfway backs at the moment. We do have a Fed meeting next week, and so the Thursday after the Fed meeting typically starts to yield a lot better intraday trading. So we'll see what we get on the Fed meeting. I wouldn't encourage you to trade around the meeting announcement on Wednesday afternoon. Things can be super whipsawy, and that's where you're going to see slippage and blowing through orders and whatnot. So keep your head up next week, and I will talk to you all soon.